Yeah, so what can investors expect for the week after the stock market's worst week in more than 2 years? Joining us now, John Petrides of Point View Wealth Management and Joseph Sroka of NovaPoint Capital. Gentlemen, good morning.
Good morning.
Good morning.
John, let me start with you. Look, I mean, we've obviously had a lot of volatility in the markets. You had investors pulling out more than almost $23 billion out of mutual funds and ETFs over a 7-day period that ended on Wednesday. Does that tell you that this was just kind of a simple correction, a little bit of a pullback that was healthy, or does that tell you that the average investor is nervous?
Well, it is nice to wake up.
Oh, John, go ahead. I'll start with you. Same question to both of you, though.
It's nice to wake up this morning and see green on the screen, that's for sure. We would expect to see more volatility probably throughout during the week, but we didn't get any sense at all from our investors and clients of a sense of panic. The market had been doing very strongly, returns have been strong, and I think investors understand that the strong jobs data that we had on February 2nd is going to lead to rising interest rates, which everyone was expecting at some point to happen. And I think that's what's coming to fruition here. And the movement during the week, I think everyone knew something unusual was happening, but there wasn't any sense of panic at all, mere curiosity and looking to take advantage of the sell-off.
Yeah. Well, Joseph, if you look at gold prices, I mean, that's where you would normally see that fear. But we had the largest price decline in 2 months in gold last week. So nobody's really rushing for that safety net.
They're not rushing for the safety net, and what you saw last week was a big autocorrelation where all the asset classes were moving together. And that just tells you that there was a liquidity issue in the market as people were unwinding that VIX trade.
All right, John, what about government spending? We've got a lot of news coming out of Washington today, in particular, $1.5 billion infrastructure plan that's going to be proposed by the president. But there is concern with this new budget we're going to get, what we're going to get, obviously, with this new spending, with the new budget. There's worry about the deficit out there.
Yeah, I mean, with $20 trillion in debt on the books for the government, that is the long-term elephant in the room as to something being so unsustainable. How are we going to address that? And but again, in the short term, it's not really something that you could totally invest against today. But clearly, that's one of the big long-term worries for investors.
Obviously, too, Joseph, if we look at kind of the movement we've seen in the VIX, the VIX spiked 70% last week. Do you think that we're going to have a calmer week? Do you think that the volatility might be moving away now?
I think we need to have a calmer week to give investors confidence to come back in the market. But I think we've probably seen the low in the VIX for the year. And as I mentioned when I was on the show last month, I think volatility is just going to increase as we move forward here. Maybe a VIX range between 20 and 30 might be where we live for a little while until things calm down.
Yeah, and also, John, last question here, looking at what the central bank movements are going to be this year, not just the Federal Reserve, but global central banks. Do you think that there's going to be more pressure on banks to actually raise interest rates even further than predicted right now?
I think that's probably right. But the reason for rates to rise is very healthy because the global GDP is quite strong and solid. So, rising interest rates because of inflation led by strong fundamentals is a good thing.
All right, John, Joseph, gentlemen, thank you very much. We shall see how the markets play out. It's going to be another fun roller coaster ride today. Thanks, guys.